Okay, picture this. You just got your paycheck. After rent, groceries, and that Netflix subscription you keep forgetting to cancel, you've got $500 left over. Now here's the question that's probably kept you up at night at least once. Do you save that $500 toward a house down payment? Or do you throw it into the stock market and let it ride? Because here's the thing, everyone's got an opinion. Your uncle at Thanksgiving swears real estate is the only way to build real wealth. They're not making more land, he says, for the 10th year in a row. Meanwhile, your coworker won't shut up about his Tesla stock and how he's basically going to retire at 40. And honestly, both of them sound right. That's the problem. Real estate feels safe. It's something you can touch, live in, show off to your friends. But stocks feel like magic, numbers going up on a screen while you sleep. So which one actually wins for someone like you, a regular, middle-class American, who doesn't have a trust fund, doesn't have insider tips, and just wants to make a smart move with the money they've actually got? That's exactly what we're breaking down in the next 6 minutes. No fluff, no Wall Street jargon, no get-rich-quick nonsense. Just real numbers, real trade-offs, and a straight answer by the end of this video. Because whether you're team, buy a house, or team, buy the dip, by the time this video's over, you're going to know exactly where your money should be going. Let's get into it. Why your parents think real estate is the only real investment. Let's talk about your parents for a second. Or your grandparents. Because if there's one financial rule that got hammered into most of us growing up, it's this: buy a house. It's the American dream. And look, I get why. For decades, that actually was true. Your grandpa could buy a 3-bedroom house in the suburbs on a single factory paycheck. Home prices went up steadily, interest rates were manageable, and owning property basically was the definition of making it in America. White picket fence, backyard barbecues, the whole thing. That mindset didn't come from nowhere. Came from a system that, for a long time, actually worked that way. But here's what nobody tells you. The world your parents bought their house in is not the world you're buying a house in today. Back then, the average home cost about 2 to 3 times the average yearly salary. Today, in a lot of American cities, that number's closer to 7, 8, sometimes 10 times your salary. Wages didn't keep up. Home prices did, and then some. So when your dad says, just buy a house, it's an investment, he's not wrong based on his experience. He watched his $60,000 house turn into a $400,000 house over 30 years. That's real. That happened. But that doesn't mean the same formula automatically works for you. In this economy, with these interest rates, in this job market. This isn't about disrespecting the older generation's advice. It's about understanding why they believe what they believe, so you can figure out if that belief still holds up today. Because here's a truth that trips a lot of people up. Something can be culturally true, passed down, repeated at every family dinner, treated like common sense, without still being financially true. So before we crown a winner between real estate and stocks, we need to separate nostalgia from numbers. We need to ask, is buying a house still the smartest first move for a middle-class American in 2026? Or has the game quietly changed? Let's find out, starting with the actual math. Your parents never showed you. The real math, down payment versus the stock market. Alright, let's get into the numbers, because this is where things get real. Say you've saved up $40,000. Option 1, you put that down as a 20% payment on a $200,000 house. Option 2, you drop that same $40,000 into an S&P 500 index fund, and just let it sit. With the house, you're not just paying that $40,000 once. You've got property taxes, homeowner's insurance, maintenance, and maintenance is brutal. Roof, water heater, AC unit, that random plumbing issue at 11 p.m. on a Sunday. Experts say budget 1% of your home's value every single year just for upkeep. On a $200,000 house, that's $2,000 to $4,000 every year, before you've even made a mortgage payment. Oh, and let's talk about becoming a landlord, because a lot of people think, I'll just rent it out and be passive. Passive. You're now the person tenants call when the toilet overflows at midnight. You're chasing late rent payments. You're dealing with vacancies where you're paying the mortgage with no income coming in. It's a job. A real one. Some people love it. Most people underestimate it completely. Now flip to the stock market side. That same $40,000 in an S&P 500 index fund, historically averaging around 7–10% return per year after inflation, could grow to roughly $80,000 to $100,000, plus over 10 years, and you didn't have to fix a single water heater. You didn't get a call at midnight. It just worked quietly in the background. This is the magic of compound interest. Einstein reportedly called it the eighth wonder of the world. And whether he actually said that or not, the math backs it up. Your money makes money, and then that money makes money too. It snowballs. But, and this is important, stocks can also drop 20–30% in a bad year. Real estate feels more stable because you don't see the price change daily. But feeling stable and being stable aren't always the same thing. Here's the real difference most people miss. A house is a leveraged, a liquid, high-maintenance asset. Stocks are a liquid, hands-off, historically higher returning asset, but with more visible volatility. Neither one is automatically better. They're just built for different lives, different goals, and different levels of involvement you're willing to put in. So now that you've seen the real math, not the Thanksgiving dinner version, let's bring it all together and answer the question you actually clicked this video for. What should you do with your money? Which one should you pick? The honest answer. Okay, moment of truth. You stuck with me this long, so you deserve a real answer, not some wishy-washy, it depends, and then I end the video. Here's the truth. This isn't actually a real estate versus stocks battle. That's the wrong question. The right question is, what does your life look like right now? If you're in your 20s or early 30s, moving around for jobs, still figuring out your career, or not 100% sure which city you'll be in 5 years from now, locking up your savings in a house is risky. Real estate rewards people who stay put. You typically need 5–7 years just to break even after closing costs, realtor fees, and the down payment. Sell too early, and you could actually lose money on a winning investment. For you, stocks, specifically boring, low-cost index funds, are probably your fastest path to real wealth. Start now, automate it, forget about it. But if you're older, settled, married, kids in a specific school district, planning to stay in one place for a decade or more, real estate starts making a lot more sense. You get forced savings through your mortgage payment, tax deductions on your interest, and something stocks can't give you, leverage. You control a $300,000 asset with a $60,000 down payment. If that house appreciates, you're earning returns on the full value, not just your down payment. That's powerful, when done right. And here's a secret a lot of financial gurus won't tell you up front. The wealthiest people don't choose one. They do both. A home to live in and live investments building quietly on the side. It's not either or. It's sequencing. What makes sense first, based on where you are in life. So here are 3 quick, actionable tips before you go. 1. Before buying any property, make sure you've got 3–6 months of expenses saved separately. Don't be house rich and cash poor. 2. If you're renting right now and investing the difference in an index fund, you're not wasting money on rent. You're buying flexibility, and flexibility has real value in your 20s and 30s. 3. Whichever path you choose, start today, not next year, not when I have more money. Compound growth and equity building both reward time in the game, not timing the game. So, team house or team stocks? Drop your answer in the comments, and if this video actually gave you some clarity, smash that subscribe button, because next week, we're breaking down the biggest money mistake middle-class Americans make in their 30s. See you in the next one.